Shalom, love, and salutations, good people. Thank you so much for tuning into the Slow Wealth podcast and stream today. We are Kendra.
And Ramon.
And as we have with our previous shows, we always start with the powerful motivational quote. And it starts by saying, success does not come from what you do occasionally, it comes from what you do consistently. Boom.
Yeah, that was pretty good. That was pretty good.
It was. It is. So, you just got to make habits, temporary habits, into permanent solutions. All right. And today,
Who we got
today we have our interview with Devon, the accountant. Do you want to tell people where you work? Is that okay? Or
Yeah,
okay.
absolutely.
With Bland and Associates, is that right?
Yes.
With Bland and Associates accounting firm in Omaha, Nebraska. This is my little baby brother, so I'm so proud today. I am so proud today. I'm like ecstatic. And Devon, so how are you feeling today?
I'm okay. It's a nice Sunday here in Omaha. Got to get out with the dogs and hang out, enjoy some of this nice weather.
All right, you do that. My little brother's so cute. Okay, so we are going to just kind of go through this interview by letting you kind of take the lead. We will ask some questions here and there, a little bit about what you do and advice that you could give people about, their taxes and what an accountant does, just preliminary stuff like that.
Yeah. All right. Sounds good.
Okay. So just to start, just tell us about a little bit about what you do. This is your time.
Okay. So like Kendra said, my name is Devon. I am an accountant at Bland and Associates, a senior accountant. I am not a CPA quite yet, going through the eligibility process for that. I've been working with Bland for going on 10 years now. Been on the tax team for roughly 7-8 years. And I love it. I love the people I work with. I love the client interactions, and just helping people overall manage, their tax situations, because it's a very complicated system that not a lot of people know about, but they don't understand. So it's helpful to have someone there to kind of guide you through it and tell you the do's and don'ts of the situation. So yeah, I love it. I love the work that I do. And it's just, tax returns as well as consulting in the off season of, people want to buy a building or buy a new car and, talking them through what they should do. Because it's always best to involve your accountant before you do something rather than after. Because if you do after, then you might have missed a step that cost you thousands of dollars of deductions. You want to bring them in before and let them know what you're going to do so that they can help you maximize the tax benefits of whatever venture you're going to do.
Oh, wow. Okay.
you gotta love accounting, boy. Man,
right.
I ain't got that patience.
So tell us about you, not what you do.
Yeah.
You.
So I'm just Kendra probably didn't fit into this mold even when she was growing up, but I'm the classic Midwesterner. Not really into big cities or anything like that. I've done a lot of traveling to places like Portland, Chicago, but I'm pretty much a homebody. I like to hang out with my dogs and my fiance. We're gonna get married here in October, so that's pretty exciting.
Sorry to hear that, bro.
Yeah, it's gonna be fun. I'm excited for it.
That's good. That's good.
But yeah, just like hanging out with friends, getting outside, hiking. Haven't really gotten to the camping scene, but as time goes on, I would really love to start like camping and possibly hunting and stuff like that. But that kind of just says what kind of things I like to do. I also play a lot of video games in my spare time, but Yeah, that's pretty much me. Just I just like hanging out, pretty relaxed and not trying to do too much.
Oh, my
Man.
little country brother.
Man, so he loaded up with the pistols back there. I got you, bro.
Right. Okay, well that's so great. So talk to us about how long you've been an accountant and how you got started.
So I've been with Bland basically my entire career. I started with Bland out of high school, basically in the admin department, doing the standard scanning, shredding, all the little small things that you could trust a high schooler to do. Then I went to the University of Nebraska at Omaha. I was originally, before got to Bland, I was originally going to go pre-med. That was basically my plan, but then weighing the options of, going to college and then medical school versus just going to do my undergraduate for business with a concentration in accounting, 4 years versus 8 years of school and, pretty good money straight out the gate. So that's really what drove me to be in accounting and just the aspect of having that client interaction of, talking to people and people involving you not only in their businesses but in their lives. It's like you develop kind of a personable friendship slash business relationship of, they invite you to come hang out with, their friends who are also business people, and you get to uh, expose yourself to a bunch of different industries like marketing and real estate and even like things like manufacturing, because you're going to meet these people and they're experts in their own fields, but you're, listening to them talk about their own fields. So it's a lot of exposure, and I'm a huge people person. I love, going out and meeting new people. Obviously it's nerve wracking for everybody, but it's kind of one of the things that I really enjoy doing in my job.
That's good, man. Because you know what? It's a lot of times they say it's not about what you know, it's who you know. And so you know those different people, and they expose you some things that most people wouldn't know about unless
Right.
they was in your industry. So yeah, everybody needs an accountant. You know what I'm saying? You that guy, and they like, hey, how can I save some money?
There's
Right.
three
How can you
constants.
make some money.
Three constants: life, death, and taxes.
Man, don't you know it? We got to deal with all of them. All right. So hey, man, let's get into it, man. Because we really want to make this interview obviously based on taxes,
Mm-hmm.
and really give people insight to that and the do's and don'ts, and how we can save money, how we can actually make taxes work for us, right?
Mm-hmm.
Because a lot of people, IRS is like the boogeyman,
Yeah.
stay away from it, you know what I'm saying? So
Yeah.
why don't you tell us what you think the relationship between an accountant and your client should be?
Yeah. So the relationships that are very beneficial overall are the relationships where it's not just I come to you, get my taxes done, and then and then I don't talk to you for another year until it's done. Obviously, if you are someone who is just a W-2 employee with you don't have any businesses or rentals or things like that, that kind of relationship can work. You just only need them to file your taxes, and then but if you're doing things like investing in stocks and things like that, investing in real estate, have businesses, those are the times where you want to have a more continuous relationship with your accountant, as well as a positive one. You want it to be someone who you mesh with not only professionally but personally, because it's not going to be a fulfilling partnership if you don't mesh well with them, because they're going to offer you suggestions of you should do this, you should do that, but if you don't mesh with them or you don't trust their judgment, then you're not going to take advantage of their suggestions. So it's always best to have someone you mesh well with personally, who you don't have to go out and have a beer with them, but you could have a personal conversation about, hey, how's the family? How's the kids? Really amicable, as well as have that trust of they have your best intentions at heart, and the fact that they know your situation, inside and out, so that they can make the best educated decision, because accounting is a spectrum of, what you do know and what you don't know. So you might be getting a suggestion from an accountant who doesn't know about a whole other side of a situation. They're giving you a suggestion specifically with what they know, but if they don't have the full picture, then they can't give you a quality suggestion. So it's always best to have someone you feel comfortable with talking to on a consistent basis, and establishing that rapport.
Okay, so they should be closer than your girlfriend, your wife.
You gotta let them know where all the money is hidden.
Man, hey, well, you gotta do what you gotta do.
Right.
So, all right, so this is probably a good question. So, like, when you have the influx of people from out of town moving to cities, especially with COVID, right? So you got a lot of people moving from, California to the Midwest, or, New York, the East Coast to other cities, right? And they're working remotely. I think one of the questions people have is, do they keep that same accountant that they had where they were living? Or now where they're going? So some people think you have to have an accountant where you live. So, like, is that true, or can you use an accountant and keep that same accountant, where you used to live?
Yeah, that's a great question. I have a lot of clients who are all across the United States. Some that have started in Bland, they lived in Omaha for a period of time, and then they moved out and they stayed with us, or people who live in another state who just reach out to us for, whatever reason. Maybe they have a business that operates mainly in Nebraska or something like that. But it's kind of up to the person who has the tax return that needs to be filed, because a lot of states are very different in terms of what their tax returns look like, what their instructions are, what you can adjust versus what you can't. But a lot of that is, some of it is, expertise, but a lot of it is just software. So if you do have that rapport with your accountant, and you really like them and they do great work for you, but you have a new opportunity somewhere else, it's 2021. Modern technology has made communicating so much easier. You can, scan and upload your documents. You can email everything. There's encrypted portals and all these extra pieces or softwares that you can use to communicate effectively, and at the same time be, thousands of miles away. So it is definitely easier now than it was, 20 years ago for, moving out of state and, trying to stay in touch with your current accountant. But if you do have that rapport, you can get past all of the differences in the states and stuff like that. But so you don't need to find an accountant in your state in order to successfully file a tax return. If you have a good rapport with your current accountant and you move, definitely keep in touch with them, and they'll, be more than likely excited that you stayed with them, and work hard to keep you and make sure your tax return is updated the way it's supposed to be.
Oh, okay.
Yeah, that's the big thing. Nobody want to owe tax. You know what I'm saying? That's the main thing. I don't want to owe.
Yeah.
And do you suggest? Well, I guess I should say this: how should people prepare for tax season?
Preparation comes in a lot of different forms. I have accountants who do everything from, gathering up every receipt that they've ever had for that year, or
what about the shoebox?
Yep, in a shoebox. And you'd be surprised at how often that happens. We actually have an elderly client. I love her to death, but so she her husband used to do all the tax stuff, get all the documents ready and things like that. But then a few years ago, he had passed away. And so she obviously was out of touch with all of that. She didn't know anything about the taxes. So she would come with like trash bags full of documents and, bring those in because she's like, my husband took care of everything. I'll pay the bill for whatever, you have to do to get through all the documents. Like, that's not a problem, but I just don't personally know what you need versus what you don't. So I just brought everything.
Trash bag.
Yeah, it happens, because, usually one person in the family, the husband or the wife, is the one who does the taxes or, works with the accountant to get the taxes filed. And the other person really isn't involved, which is, really common, but, you always want to know kind of baseline of what's going on. But yeah, so to answer your question, it's a variety of things. What usually happens is if they have a business or if they're personal, they just gather all their documents, whether they're electronic, like your W-2s and your 1099s and all that stuff, they gather them all up and then they just, give them to the accountant. That's kind of how you prepare for it. You definitely want to be in the know of what documents you are going to receive because, if it's something completely new, you might not be on the lookout for it. And things come at varying times. You could get something in January and then you can get something all the way in March. So it's definitely powerful to know exactly what documents you are supposed to receive. That way you can have like a checklist of, okay, I have this, that way your accountant doesn't accidentally file your return without a piece of information that you just haven't received yet. Because that is very common when people invest in a business, which is why in the beginning I said you want to involve your accountant because, something happens or you get a document and you're like, oh yeah, I did invest in a business, in June, and then your accountant didn't know that. So they filed your taxes because you didn't receive your K-1 for the business yet because the business wasn't done yet. So that's another thing. But generally, at least our firm, I don't know about many other firms. I know mid-sized firms to large firms do this. There's called a client organizer, which is basically a general checklist of here's the things that we received last year. Are we going to receive things this year? Here's a questionnaire for you to fill out, just to get the conversation going so that we can, work together to figure out, okay, do we have all the information? So little helpful things like that of just making sure that you have all your documents or what you're going to receive and filling out or requesting a client organizer from your accountant is definitely helpful for getting prepared for the tax season.
What's a K-1 form?
That's a good question. Not a lot of people know about that. So when you have a business that's a flow-through entity, so what a flow-through entity means is that the business itself doesn't pay taxes. The income is reported on the business return, and then it produces what's called a Form K-1 or Schedule K-1. And then you give that K-1 to the partners. Each partner gets their own individual K-1. And what it does is it just splits the business's information into chunks of percentages. So if I own 10% of the business, I report 10% of the income. If someone else owns 50%, they report 50%. So each of us get an individual K-1 that shows exactly how much income we are responsible for.
Now, how does that work if you're like a married couple? Is it still 50-50 or is it?
Yeah, so you still get two separate K-1s, but the K-1s get put on the same tax return. So you could, if I don't know, it's not possible to, but if ideally you had one K-1 versus two K-1s, it wouldn't matter in terms of money. Like they would end with the same result. It's just the formality of having the two separate K-1s representing the two partners of a firm or of a business is how that works.
Oh, okay. Well, that's good to know. A lot of people probably just want to know that, especially for this year, because you have so many people starting businesses.
Mm-hmm.
This is a side that they don't know. They just like that. I did an LLC. I got my EIN number,
Yeah, that's about it.
You know what I'm saying? Like, they don't know, like, the ins and outs of how to file it, which comes to our next question. When do you say, because we all know that normally taxes you have to file by April 15th.
Mm-hmm.
I think this year and last year they extended that because of COVID.
Yep.
But like you said, being able to or needing to stay in contact with your accountant year round, when would you say is really the best time to file taxes? Is it like in April, right before the deadline, or February?
Mm-hmm.
When would you say?
Yeah, so it's dependent on obviously the accountant and the workload. I have accountants with, I do their personal return as well as they have like 6 or 7 separate businesses.
Mm-hmm.
So their tax situation is a lot more complicated. Therefore, you want to give your accountant more time to fully absorb everything, because in my opinion, a good accountant isn't someone who, just takes your numbers and, throws them onto a tax return, right? That could take me 15 minutes to do. I could take your numbers and just throw them on a tax return and then prepare it. But, someone who I feel is a good accountant is someone who looks through your financials, looks through what's called your general ledger, which shows all of your activity, and they might have to pull out some stuff that is personal. But they also might find some things that are just like, hey, I see you spend X amount of dollars a month. Is this something that we can, negotiate down? Because, you've had this vendor for the past 20 years. Maybe you can negotiate a price to, pay less per month because you're a loyal customer, or, things like that, where because you can learn a lot about a business. And you can learn a lot about people and their tax documents. But it's definitely, a time-consuming process. A business return can take anywhere from, 45 minutes to 30 hours, depending on how complicated it is, especially when you start involving multi-state entities. But yeah, like I said, it just depends on how complicated your tax situation is. But there's always the extension that can be filed. We at our firm do not charge to file an extension, and there's a lot of negative misconceptions of an extension, and I don't exactly know where they come from, because a lot of clients say, I don't want to file an extension. I want it done by April 15th, and there's no penalty. Like, you could file an extension and file it April 30th, and there's really no difference between filing it April 15th versus April 30th. But it just gives your accountant more time, as well as the taxpayer more time to get all the information in, because there are some forms that you might not receive until May, especially with COVID. So you can't file an incomplete tax return. The only stipulation is that, which a lot of people probably don't know, is that, and this is kind of a counterintuitive way to set it up, but if you owe money, on your tax return, you have to have that paid by April 15th, regardless of if your return is ready to file or not. Now, the caveat is, how do you know what you're going to owe if you don't know what's, coming? You don't know what you don't know. So, it's trying to figure out how much money you need to pay in by April 15th, to get that extension, and the extension doesn't require a payment, but if you pay before you extend, then it eliminates what's called a failure to pay penalty, which it could be probably about 5% of whatever you owe, in addition to interest for every day that you're late. But the interest is very minimal. But yeah, so definitely filing or getting your return in the door early, even if it's not everything, especially if you expect that you're going to need to extend, you want to get it, in as soon as possible, especially for businesses. Get your financials updated, up to date as soon as possible after the year end. A lot of people wait until December 31st to start entering all their December activity, and then that rolls over into January, and then they get backed up. So you definitely want to get all your ducks in a row before the end of the year. That way, you can do those last minute tweaks when January hits, and then go from there.
So you said something. I just want to ask real quick. So you said like there's no penalty really to extend your taxes, but if you owe, they're going to hit you with that failure to pay.
Yeah.
From the deadline of April 15th until whenever that is.
Mm-hmm.
Said if you pay ahead of time, you won't get hit with that failure to pay.
Mm-hmm.
Is there a minimum? Can I like say, all right, here, I'll give you $100. Give them $100 and then
yeah. Yeah. So
how does that work?
Yeah. So there's a couple different penalties at play when you file your tax return, right? So if you file your tax return before the deadline, right, and let's say you don't pay anything but you owe, there's what's called the underpayment penalty, which is another kind of counterintuitive system of you might not have owed in the past, but you should have known you owed this year, is kind of how it's set up. But you don't, obviously, like I said, you don't know what you don't know. So you might not know that, this $30,000 that you received from a business investment was taxable or something like that. And if you didn't pay in and you owe, they're going to assess an underpayment penalty because you owed a certain amount above last year, and they're going to do the math to see how much the penalty is. I do not know what the penalty is off the top of my head, percentage wise. It's probably somewhere in the same ballpark as the failure to pay penalty. And that one also has an assessed interest rate as well. So there's the failure to pay penalty, which, like I said, if you don't pay before April 15th, that gets tacked onto your tax bill. Underpayment penalty gets tacked onto your tax bill, as well as the interest. So if you file after April 15 and you owe, you could possibly have two separate penalties in addition to interest added onto your tax bill.
Damn.
Yeah. And so
they do not be messing around.
Yeah.
Wow.
So to answer Ramon's question, if you do pay that $100, but then it turns out you owe, $5,000, you might avoid the failure to pay penalty, but you're going to get hit with the underpayment penalty because you didn't pay up to that full $5,000.
So which one carries a higher penalty, the underpay or the failure to pay? The failure to pay.
That I do not know off the top of my head. I would assume the failure to pay penalty, in my experience, has always been higher. Just judging by what I've seen in the software. Like I said, I don't have the exact rates memorized, but the failure to pay penalty is likely higher than the underpayment penalty.
Yeah, there's gonna be some folks that weren't gonna know that. They like, all right, look, I pay $100. You know what I'm saying?
Right, I pay $100. I want to make sure that I get no penalties. How about that?
Hey, for real, we trying to find the loopholes. You know what I'm saying? So, anybody watching this, make sure you pay, $100 and miss out on that failure to pay, but you still gonna get hit with the underpay. That's true. You know what I'm saying? Hey, we just don't want to, want to decrease those expenses. So.
And that's why you need a relationship with your accountant, right, Devon?
Yeah, because I can, like I said, it's software. It's all software driven. In this industry, 20 years ago, it was all manual, filling out documents by hand and stuff like that. But now it's all software driven. So you could tell me, estimates of, I think this is going to be this much. I think this is going to be this much. I can plug it in, calculate how much, I project you owe, but, it's obviously not going to be anywhere near accurate because I don't have the exact information, but, it's the underpayment penalty is basically taking the difference between how much you paid versus how much you owed, and then, penalizing the difference between the two numbers. So if we get closer to that number that you owe, then that will ultimately help limit the underpayment penalty, or even, get you closer to a refund, which a lot of people really like refunds, but, you in tax, intro to intro to individual tax in college, they, explained tax refunds of let's say you get a $5,000 refund that the government has held onto your money for an entire year and then gave it back to you with no interest. You could have taken that $5,000 and invested it, or bought something that you really wanted. You'd have that $5,000 over time rather than one big chunk, but you could do something more productive with it rather than letting it sit with the government. So you always want, in my opinion, and by the way, these are all my expressed opinions.
Let me say what they say in that movie, Message.
Yeah. Yeah. Disclaimer: this is not professional paid advice. Take this all with a grain of salt. You always want to consult your accountant with anything that you hear, anything that you read, anything that you see, because they will ultimately be able to tell you if it is good for your situation. So now we got that disclaimer out of the way. In my opinion, I prefer to either get a very small refund or maybe owe a little bit at the end of the year. I don't want to owe a couple thousand, but maybe a couple $100, because that would tell me that I've basically maximized every dollar that I've earned. I've been able to keep it in my pocket throughout the full year. There's nothing worse than getting a couple $1,000 refund, and you're like, wow, if I would have had that couple $1,000 throughout the year, then maybe I could have gone on that vacation. I could have gone and hung out with friends, rather than kind of pinching pennies and stuff like that. So it's definitely better to get a smaller refund or owe a little bit and get to that line rather than, being on complete opposite sides of the spectrum of that line.
You're going to have everybody messing around with their W-2 forms.
Yeah.
And they're going to be trying to figure out, okay, so this week, if I claim 0, this week, if I claim 9 or exempt or whatever.
Yeah, and it's crazy because they recently changed the W-4 is what it's called. The W-4 is what you fill out at the beginning of the year. Mm-hmm. And they changed that, before, you used to claim 0 or 1 or whatever. Now they're just like, how much money do you make a year? And then it's just like, okay, now take that number, divide it by this number. And then how many kids do you have? Okay, multiply this 2,000 number. And it's just like, I just want to claim 0 or 1. Like, that's the simple way. But now you actually have to write in like thousands of dollars, and it'll be like, okay, here's how much you should have withheld. And it's supposed to make it more accurate, but that remains to be seen over time to see if people actually, because it's meant to get you closer to that line so that you don't have these huge refunds or don't owe a lot. But, we'll have to see how effective it actually is.
Oh, wow. So they're making the whole process in paperwork. It's like they're just sending it off to basically, if you look like it's the consumer.
Mm-hmm. Yep.
So they have to figure out, okay, if I am honest, I'll put in my actual yearly salary to make sure that, enough taxes are deducted so I won't owe at the end of the year. And just kind of going into that for businesses. Now, this is what we were told. For businesses, you almost want to owe taxes because it might look better to potential clients or whomever if you earned a certain amount of revenue. Am I explaining that right, Ramon?
Yeah.
Okay.
Yeah, they tell us that you better to owe. So like if you have a business, you at least want to show that you're getting income. But if you're taking a lot of deductions, then it decreases what you're actually making in a sense.
Right.
It looks like the business is not making money.
Mm-hmm. So yeah, that's a common narrative that you hear a lot as an accountant, and it's true to some degree, right? So what I mean by that is there is a difference between what you report on your business financials versus what you report on your tax return, and that probably sounds kind of devious or whatever, but like when you really think about it, so. Let's say I buy a $50,000 piece of equipment, right? And I pay monthly on it. And I have interest, but I also have the depreciation of that piece of equipment. So if I'm allowed to take the full depreciation in that year, my profit and loss is going to show that I'm, negative, or I lost money this year. But in all actuality, it's just the fact that depreciation is there. I'm getting a $50,000 expense in 1 year. Obviously, that's going to drive my profit way down. But, any competent banker and stuff knows how depreciation works. So they would just add that back to the bottom line to actually figure out how much profit you actually had. So your business financials will show, a loss, but in all actuality, you probably made a profit, but you just had the preferential bonus depreciation that allowed you to take that loss while at the same time cash wise making a profit. But yeah, and that's just one of the many differences that you can have. Things like an accrual to cash adjustment, other things that are basically timing differences. It doesn't really represent what cash you made. It just represents when it's reported, is how it's basically described. So you can still have a very profitable business, but not owe any taxes. So the narrative is somewhat justified, and on the surface it is correct, but there's little things that you start to learn as you become more well versed about how to structure your business, or when to buy things, when to not, in order to show on the tax return that it's a loss, but in all actuality you're profiting.
Okay, so it's really situational.
Yes. Yeah, everything with taxes is 100% situational. And that's one thing I love about it, is that you have people who come from the same family, same walk of life, and their tax situations are just completely different because of one small aspect change. Someone has a kid, and the other sibling doesn't. Their tax returns are going to look very different because of child tax credit, child care tax credit. All this extra stuff that the door is open to, versus someone who's just, married or not married and stuff like that.
And we'll talk about child tax credit, in a moment. But one question that I definitely want to know is, how can you help grow a business as an accountant?
Yeah, that's that depends on, like I said, your accountant and your accountant relationship, how well you trust their judgment as well as their expertise. So a lot of accountants are honestly kind of networking hubs of, hey, I want to lower my taxes, and then the accountant's like, okay, well, I know this guy who does 401ks, and he can set up a 401k for your business. He's really good, connects you, and you can start saving for retirement. They know people who can do cost segregation studies, or they can even link you with other clients of theirs. Of you tell them, hey, I'm looking to buy a piece of property in this area of town, and they're like, hey, I actually have a client who specializes in real estate in that area of town. Let me connect you two guys together so you guys can talk and stuff like that. So that's a lot of what a good accounting business growth is, as well as one thing I ask clients who come into the door, brand new clients who want an accountant. I'm just like, what are your aspirations for your business? What do you want to do? Because some people may have lofty aspirations. For example, people in real estate, they're like, I want to start doing residential until I build up my portfolio a little bit, and then I want to venture into commercial, and then I want to stay in commercial. Then there's things to be like, okay, let's start chartering a path. Let's start making some decisions, and let me fill you in on some things that you should be on the lookout for, versus someone who's just like, I just want to own a vacation house in Florida, and that's basically it. Then it's just like, okay, well, let me tell you some things about your vacation house. And for example, if I have a vacation house that I want to use as a rental, the rule is, I think it's 14 days. So I could go and vacation in that house for 14 days, but like I can't do 15, I can't do 16. I have to be at 14, and then I can still keep it as a rental, but at the same time use it as a vacation home. But when you start taking more days, like 30 days, then even if you rent it out for the rest of the year, the IRS might disallow, okay, you can't claim the deductions, but you have to claim the income of that rental property, but they would reclassify it as a vacation home. So those are things that are, situationally, an accountant can kind of color in some of the details of things that you should expect or things that are probably going to happen that help you make a better decision looking forward to the future.
Yeah, that's good, man. Hey, because that's definitely, like you said, you mentioned something with the cost segregation. We won't get into that too much because, I've heard about it and I've read it too, and I've had a accountant, say that to me. And it's really something I think, because we never did it, but I think it's something that really could save a lot of real estate owners a lot of money.
Oh, yeah.
Go in there and they kind of pick out certain things to get some more depreciation. But yeah, like you said, like there's just several ways that people can use, like you said, an accountant, either networking or just, of all aspects to grow their business or, whatnot. So yeah, I think it is very important to have, like you said, a good accountant that you mesh well with. Because there's some bad ones out there.
Yes, definitely.
Like definitely. They just throw your stuff on a return and send you that big old bill, and you're like, man, hold on, and I owe you.
Yeah.
Right.
Yeah. Like, bro, you bad.
Yeah.
But yeah. So speaking of, kind of what we were just talking about, as far as businesses, what would you say would be different ways to kind of structure a business? And do you think it's wise to address your accountant before you start a business to know which type of entity to structure it as and so forth?
So yeah, there are definitely different benefits for different entity structures. I don't know where this misconception comes, but I'll have a call with a prospect or whatever, and I'm like, okay, what entity type are you? And they're like, I'm an LLC, and I'm like, that's not an entity type. So the entity type, so an LLC is essentially like a limited liability company, which is what it stands for, but it is essentially like a legal type thing. So that kind of protects you against being sued and things like that. So LLCs don't really have any tax implications, whether or not you have an LLC, because the different types of entities are sole proprietorships, partnerships, S corps, and C corps. So the only one, I guess maybe a C corp, I've never seen it, but like essentially all of those four entities could be LLCs. So when you say LLC, it doesn't narrow things down because those are what's called tax entities. So sole proprietorship is just one man wrecking crew, kind of just does their own thing with they can have employees if they, want, but essentially they just do their own thing.
Well, I'm sorry, I don't mean to cut you off. Yeah. But with the sole proprietorship, you said they can have employees. Are most of their employees or workers usually like contractors?
So it can be either or. I have a guy who is a sole proprietor he has a consulting business, and he's a sole proprietor and he has actual employees and contractors as well that are, W-2 employees and 1099 employees. So it can be a mixed bag, it just depends on how big your sole proprietorship grows. But the more common sole proprietorships are, your one-off things like, oh, I'm a handyman, I'm I babysit, or, different things like that, because the tax implications of being a successful sole proprietorship are so big that the moment you start making profit, you want to switch to something else, like an S corp is probably the best one. Does that answer your question?
Yes.
Yeah. So yeah, sole proprietorships, and then there are partnerships, which obviously you need to have 2 or more people in a partnership in order for it to be a legal partnership. And by the way, a sole proprietorship doesn't need an EIN. So if you just go around selling, I don't know, cell phones,
okay.
you just go around selling stuff. You don't need to apply for an EIN for that. Now, if you obviously start growing and getting more successful, then there's things you need to start thinking about, like sales tax and stuff like that. But generally, the sole proprietorships don't have an EIN that they've applied for. Partnerships are kind of the same thing, although if you want to be a legit partnership, you have to have an EIN. But partnership and sole proprietorship are probably the 2 easiest forms of entity to make. And partnership, 2 or more people. Partnerships are really, really good for real estate. I will say that.
That's going to be my next question.
Yeah, because of the way that they function, you can put money in and take money out without really impacting your partners. I mean, obviously it'll impact the business as a whole of, taking money out of the business, but there is I kind of trying to decide if I want to go into this because it's really complicated, but there's this.
Give us the gist of it.
Yeah, just give us the synopsis.
Yeah, so we're going to have some lessons because I'm about to ask you for sure. As soon
as we get out of this, we're gonna be like, "Hey, Devon."
Yeah. So there's something called basis, which essentially reports how much value or added value you have in the company, right? So if I contribute $1,000 to the company every year, over 30 years, I'm going to have $30,000 invested. Right, that goes into my basis. So if, for instance, Ramon, you contribute $1,000 and Kendra, you take out $1,000 every year. Your Ramon's basis is going to be higher than Kendra's because she's taking money out and Ramon's putting money in. So when all the dust has settled at the end of 30 years, Ramon's basis might be way up here and Kendra's might be way down here. And it also affects how much in losses you can take, in future years. But the biggest aspect, which a lot of people don't know, is that if I turn around and sell my business, right? Let's say I have a promising law practice and I take money out, which you're allowed to do as an owner of that practice. But I take money out, every year. And then I go to sell my business for a huge amount of money, that is going to be taxable via capital gains. It's almost as if you bought and sold a stock. It's kind of how it's treated. But if you don't have the basis, then that gain is going to be so taxable. I have clients who essentially take out all the money that they've made, every year. And so their bank account, sits at maybe $100 at the end of each year because they take out everything that they make. But so they're not, whatever money they're making in basis, they're automatically taking out. So if they were to turn around and sell their business for $1 million, they're going to have $1 million capital gain. That's going to be taxable. Now, in Ramon's situation, let's say he has $30,000 in basis and Kendra has $0, then you guys turn around and sell your business for, $100,000. Ramon is going to be taxed on, you split that in half, that $100,000 in half, 50. Ramon's going to be taxed on 20,000 because he has $30,000 in basis, whereas Kendra is going to be taxed on the full 50 because she has $0 in basis. So there's a element of people putting money in and taking money out that also needs to be examined, especially when you involve your accountant and say, hey, I got a really good offer for someone to buy my business. I need to know what's going to happen. And then you can list that out and say, okay, with where your basis is now, you're looking at this much in capital gains, et cetera, et cetera. So real estate is I almost said 1065s, which is the form number. So when you become an accountant for a while, you don't even use terms anymore. You use form numbers. So it's just like, you have an 8855, or it's just like it's a whole different language. But so yeah, for partnerships, it's very fluid of who can contribute what. You can contribute actual real property. If you guys had a third partner who wanted to come in and say, hey, I have this large piece of land in Kansas, I want to contribute that into the partnership for ownership, and you guys debate how much ownership percentage you want to give them, et cetera, et cetera. S corps are so a 1065 or a partnership is best for real estate. I will say that. An S corp, which is an 1120S, is a slightly more complicated thing to get into, but it's mainly for your service industries. Well, I don't want to say actually service industries. Basically anything else that isn't real estate is kind of where S corp comes into play. So if I do consulting, if I'm an accountant, if I even sell things like physical things, because of self-employment tax and stuff like that, you can avoid paying self-employment tax by being an S corp. But like I said, it's a little more complicated. You have to apply for an EIN as a C corp, and then you have to file an election to become an S corp. So it's a few more steps, but an S corp is leaps and bounds way better than a C corp and way better than a sole proprietorship.
Oh, wow. Yeah, that's way too complicated.
Yeah.
So if anyone has any questions about sole proprietorships and S corp, C corps, and all that, they should probably talk to their accountant or a tax attorney or somebody.
Yeah,
because that is a very difficult decision of what entity to use when you're starting a business. Because you already have the complications of finding out what the business is going to be and how you're going to be creative and all the marketing and all this and that, and then you have to worry about, okay, what entity am I going to use? Am I going to be an LLC? And like you said, I didn't know that about an LLC, that it wasn't an actual entity, but it's like a sub something.
Yeah, like a legal protection, essentially.
So yeah, it just becomes way too complicated. But you mentioned something as you were explaining the entities. What are the tax obligations for businesses?
So if you do have one of these flow through entities, which is a partnership or an S corp, those have their own separate tax returns. Right. Okay. And then, like I said in the beginning, they produce a K1, and then that goes on your personal tax return. So the main obligation for a business, a flow through entity, is its own separate business return that is due March 15th. And that also can be extended to September 15th. Now, there are extra taxes or extra obligations that can fall under that, depending on what type of work you do. For example, if you sell things, like actual like retail goods, then you might have a sales tax obligation, which is something that's probably needs to be done monthly. If you have employees, you might have a payroll obligation, or if you have independent contractors, you may have a 1099 obligation. So those are the larger aspects of obligations overall that you would have. You don't always just have your business tax return, and you don't always just have your personal tax return. You always need to, like I said, involve your accountant, let them know, not exactly what you're doing, but let them know what you are doing so that they can make sure you're compliant. Because nothing's worse than, finding out that you've been selling stuff and collecting sales tax, but haven't actually filed a sales tax return. And, for a lot of people, it's because they don't know. They just know that you collect sales tax, but they don't put two and two together that you're actually supposed to collect that and then send that off. So, because and sometimes it's because
I'll be right back.
And it's more times than not because of whatever payment processor they're using is automatically collecting that sales tax. Now, it depends if, like Amazon, for instance, Amazon will collect your sales tax for you and then pay it on your behalf. So you don't even have to deal with it. But I mean, I don't know what Square does. I assume Square would do something similar. But if Square didn't, then you would need to know that, because if you don't know, Square is depositing that sales tax into your bank account every whatever, and you're just keeping that money rather than paying it to the state of wherever that you should be paying it to. So that's a good conversation to have. But if you do professional services, it depends state to state, obviously. But if I go do consulting in Alabama or whatever, am I supposed to charge sales tax for that? You would have to try to figure that out. But definitely, if you sell tangible things, then you might want to look into, should you be filing sales tax returns?
Well, you're gonna have a lot of people sweating right now. Like,
yeah, that's
about 5,000 in sales.
Right. This is my favorite part. What are some home office and business expenses that someone can deduct?
Yeah.
Now, hold on. Now, before you answer this, we got to make it clear, because this is a big thing, right? Because like I said, 2020 was probably the year of entrepreneurs, right?
Mm-hmm.
People were just trying to get in. Like, I got to do something. I got to start selling cakes. I got to start something legal, right? You know what I'm saying?
Mm-hmm.
So this is thing, I think that a lot of people, and when they have bad accountants, that's why, we talk about it, they're putting the emphasis on having a good accountant, because they're going to be able to tell you what you can write off and how you can write it off, right?
Mm-hmm.
So when you answer this question, try, if you can't answer it basis off of what type of company somebody has. So if it's something that they do in their house, on the road, but they use something in their house, see if you can kind of differentiate that for us. And like you said,
I'll use myself as an example. Okay. I'm gonna raise my hand. Okay. So as a realtor, and I do work from home, right? I do use my car pretty often. How would this help other people that are, like me, 99 contractors?
Yeah. So I will throw the disclaimer in there again, because this is a very volatile topic. People will go to someone and say, "Hey, I heard I could do this, this, and that. This person told me to do it." So I will say this is not, actual advice that I believe that people should follow. This is just kind of offering the educational piece behind it to start that dialogue with your accountant and, possibly save some tax dollars. With that said, so for a realtor, well, first I'll start with the easiest one. If you are just an employee, obviously COVID has limited a lot of people to working remotely from home. If you just make a W-2, you don't own your business or own a business or anything like that, then there's nothing there for you, at least not anymore. I think it was the Tax Cuts and Jobs Act that removed unreimbursed employee expenses, which was a deduction, for a lot of people, especially people who were like salesmen. They had those for, things that they were doing on the road and stuff like that for the business that was highly commission based. That was a huge deduction for some of them, but that got removed. So that's automatically, if you're an individual person who just makes a W-2, there's nothing really you can do in regards to that. Now, however, for a realtor, that depends on, like you said, your entity type. So you could be a sole proprietor realtor and add your home office as a business asset. So what you would do is you would take the square footage of your office, and then you would take the square footage of your house, and and you divide the office by the house, and that would give you a percentage, right? That'll give you your business use percentage, and then you multiply that percentage by every expense in your house, like utilities, real estate taxes, mortgage interest, all that stuff. And then that will spit out a business, home office expense. But there's also what's called the simplified method, which, is probably easier and less audit risk, probably, is how I would say it. But essentially, the IRS just gives you, okay, take your office square footage and multiply it by $5 per square foot. And then that's going to be your deduction. So that obviously alleviates a lot of paperwork, a lot of calculating, and totaling up, going through your utilities and totaling up what you paid each month. You can just take the $5 per square foot and call it good. Now, if you have a flow-through entity, it gets a little more complicated, because as a sole proprietor, your business and you are basically intertwined. Like, it's not its own separate entity. Now, when you have a flow-through entity, those are going to be two distinct separate entities. And when that happens, it's harder to capitalize personal assets underneath the business for that. And not necessarily, you're not capitalizing your full house, but putting your house on your business return definitely throws up some red flags. So what a lot of people I've seen, I've never personally done this, but what I've seen in practice is that people set up an agreement, because you are legally two separate entities. You set up an agreement as the business, written to you as the person, and say, hey, I'm going to be renting this space in your house for, whatever. Here are the terms of the agreement you're going to pay, or, really not really any. It's very informal, because obviously you're writing an agreement from yourself to yourself, but essentially they're writing an agreement saying that they're renting this space in the home, and then they claim the home office deduction on the business return, and then on their personal return. And this is where it's actually very interesting, is they claim the income on the personal return and then offset it with the business expenses. So it's a little complicated, but essentially, let's say the business use percentage of my house is $500, right? My business reports the $500 worth of expenses, right? Because they quote unquote paid that to me personally. And then I report that $500 of income, but then I also offset it with the $500 of expenses that I paid as the person for those utilities and stuff, therefore netting it to zero, but also getting the business a $500 deduction.
See, now I want to point this out, because this is very important, because these are things that a lot of us didn't know, right? Mm-hmm. This is how people get mad when they look at Trump's tax returns. They like, this man only paid $700, and people mad.
Yeah.
Instead of trying to figure out how he did it, right? Because this is not something that's illegal.
Mm-hmm.
Very legal. It's just you have to know the right accountant to show you how to do it.
Right. Instead of people getting mad, they should be trying to figure out, okay, how is he doing something like this?
Because I've heard of that, like you said, where Jeff Bezos and all Zuckerberg, where they'll set up, like you said, set up an entity, and they might set up another entity, right?
Mm-hmm.
Hey, this entity or this business charge this business, business, and then by the time it gets to me, it looks like I didn't make anything.
And they own both companies.
Like you said, they own all these companies.
Mm-hmm.
Yeah,
passing, like you said, the income through, or the expenses through each company, the income through each company, and then by the time it gets to me, then I'm writing all these expenses off on these business on me. So, like you said, when it looks like I didn't make anything, all this money. And so, I think that's very monumental that people understand that, because I mean, dude, it's like the game is out here, man, and we got to know this because that's like I said, it's not illegal. And you get mad at Trump, who's a billionaire, you pay more taxes than him.
Right. Yeah.
Him and other people like him. It's not just him, that takes advantage of these tax opportunities. It's also people that have his access to wealth because they have a team of accountants and lawyers that will say, hey, you know what, do this. Because they'll, bring you money or revenue or whatever at the end of the year.
Right.
And, also for the longevity of their business investments and companies.
Yeah, and it's. I mean, since we're already on the topic, I will say that there was one thing that a lot of people were in uproar about. That like as an accountant, I was looking at it. It was just like, yeah, I mean that's standard. So like there was I can't remember where this house was, but he had like a multi-million-dollar mansion somewhere. That he was reporting as an investment property, right? And it's been in his family for like generations or whatever. And people were mad that he was depreciating, what seemed like a personal asset. But it's like, well, if he doesn't live in it and he just like holds it, he could turn around and sell it at any point. He could do whatever he wanted to it. As long as he doesn't live in it, technically it is an investment property. So then it can be depreciated. Now there's obviously multiple layers to that, where stuff was coming out that actually, when you go through social media and stuff like that, you see him and his family in that house like all the time. So, that's obviously where the controversy comes in. But, for someone who, say is a millionaire and they have a property in Bel Air that they just don't live in, that they just have it, and maybe they do go vacation in it for that 14 days like we talked about, they could depreciate that as an investment property because of the fact that they don't live in it, and there's obviously rules and things like that, boxes you need to check. But, as a millionaire, you probably have a team of accountants that are making sure those boxes are checked of you're not doing this, you are doing that, to make sure that all the rules are being hit. And then there's going to be some legislation put out like one thing I find hilarious is some people just don't know that tax laws or things are written so specifically because people have done it. So it's just like it's
really written for them because some of these people, politicians, they own businesses and land and property, so they know what they're doing.
Yeah, and it's like, for example, you get a deduction for a $19,000 deduction for maxing out your 401k, right? There's a reason for that. The government wants you to save for retirement. They institute these bills and these legislative changes and tax credits and things like that because they want you to do a specific thing, like contribute to retirement, or when there was the first-time home buyers credit, they wanted people to start buying homes. So there are things out there that are specifically made for people to take advantage of. And there are rules out there of things that you can't do because someone has done it successfully, and they're like, okay, yeah, we can't let people do that because that's just not okay. So.
That's true. That's true.
But not others.
Yeah, it's like the sign at the public pool. It's like, don't dive into the jacuzzi. Why is that sign there? Because someone went and did it, and it became an issue. So now you got to put a sign up there for it.
People gonna always find a way to do something that's gonna make them change the law. Like, oh, you can't have everybody do that. So,
right. So, with COVID and everything, of course, I'm sure you see a lot of different changes in your profession. Can you explain the tax deduction on unemployment income for 2020? Because pretty much most of America was receiving unemployment, due to COVID.
Right. So, yeah, this was something that actually was just passed not too long ago. We had heard rumors about it. And this is kind of like tax law in a nutshell of like, while other people are hearing rumors about like celebrities and stuff like that, things that are going on, like tax accountants are hearing rumors of did you hear that this new credit might be coming out? Like, this is the kind of whispers we are listening to. But yeah, so there was
those are the kind of rumors we want to hear.
Yeah.
We need to hear. We don't care about them. We care about the money.
Yeah.
So, a lot of people they took down the phone. They're like, man, I'm gonna have to pay. You know what I'm saying? So
right, to get some gossip, get some office gossip.
So there was there's a bill that Biden had just signed, like the 20 something. I can't remember. I think it was like the 21st of this month, where it's excluding 10,200 of your dollars of unemployment. So if you made $9,000 of unemployment, you can exclude that full 9,000 and not pay taxes on it. Mm-hmm. But if you made above 10,000, then you get to exclude 10,000 of it and then pay the tax on the difference of it, which is very helpful because obviously, like you said, with COVID, a lot of people got laid off and the unemployment benefits were getting bumped up, and a lot of people were being compensated for being laid off. So that definitely, I mean, obviously it came way late. It's March. People have already filed their tax returns and stuff like that. So having to deal with, and some people might not have been impacted by it, just depending on their tax situation, they might not have been taxed on it anyways. But if you did make a lot of money before, being laid off and stuff like that, then that's something you want to definitely take a look at and possibly amend your tax return. There's been rules within the past week of how to handle this situation. So it's constantly developing. But yeah, that unemployment of writing off 10,000, say one client who I was preparing their return for, I was, working on their return when that rumor had essentially got announced, and like their return was basically done. But I was like, I'm not filing it until I figure out, if this thing is going to happen. Because if it is, then it's going to help them. But I would rather hold off and file the return after I know for sure, rather than file now and then amend and then have to file again. So so there is a lot of holding for some clients because you just really don't know how stuff's going to shake out. So you got to wait until that legislation gets pushed through, and fortunately it was. So
man, that's good, because man, I'm telling you, you're gonna have some people like, woo, man, I was going,
yeah. I mean, it does. I mean, it helps the common man, common folk, so to speak, because everybody, COVID just didn't hit, a certain tax bracket of people. It affected everyone,
right.
And this is one that Ramon is so excited about. Explain the child tax deduction for your $12,500.
You know what? The crazy thing
he wants child labor laws.
Hey, listen, they be
child labor people to come after us.
Hey, listen, they be getting put to work right now. But no, the reason why so one thing is I heard a while ago, I had a conversation with somebody and they kind of mentioned about, we got on the subject of credit, right? And, a lot of people, growing up, you had bad credit before you was 18 because your parents put your name on some stuff and they paid the bill.
Right.
So, some people was unfortunate, and I was like, man, that's crazy. That's jacked up to do that to your child. But then it came about where, I heard that some people would say, hey, when your kid is young, add them on a couple credit cards that you own, right? They're young. So when they get, of age, 18, 21, whatever, they're going to have good credit and it's going to be established for so many years, right? Because on your credit report, the length of history actually holds a lot of weight.
Right.
So, then it kind of turned into when you talk about businesses, right? I got to a friend the other day, he owns a business, and I said, hey, I just found this out. You can have your daughter work for you as an employee. I think if she's between 7 to 17 or 18, I might be wrong. But, you can have her as an employee, and you can pay her tax free. And you can deduct that on your taxes at the end of the year, if I'm not mistaken. And I was like, bro, that's so cool. And it's like up to, I think, 12,500 for the year.
Yep.
So like, there's a lot of people out here with businesses and don't know that.
And kids with idle time.
You missing out some productions, you know what I mean? And your kid, that's an ample way to get your kids into entrepreneurship as well, right? You teaching them and letting them see what you do, and you actually can pay them. So you showing them entrepreneurship, you know, you having them dealing with finances, with credit. They're learning all this stuff on the job that you created. So can you kind of just go into that a little bit and how that helps business owners who do have kids?
Yeah. So yeah, Ramon, you're absolutely right. It is definitely when you like, the taxes is like the X's and O's of the whole situation, right? But when you start to think about like real life applications of you're teaching your kids, you know, how they're getting a paycheck, because, you know, they could go and blow that whole paycheck in like one day, and then you're like, okay, well, you're gonna have to wait 2 weeks for your next one. So, you know, you're instilling in them at an early age of saving and budgeting and things like that. But while you're still in like a controlled environment, because you don't want them to be 18 and then, you know, blow all their money and now they don't have money for rent. You want to do it at a younger age so that they're not put in a situation like that to where it's like life or death, essentially, or homelessness versus not homelessness. You want to have them get those tools on early. So there is, and this is more of a language thing. So there's kind of what I like to think of as 3 different types of things. So there's strategies, deductions, and credits, right? So strategies are things that you can do, you know, that obviously lead to bigger deductions. They're not like a deduction themselves. Like if you were to Google, you know, child tax credit or child payment tax credit or whatever, you're just going to get, you know, brought to the child tax credit of like $2,000. You know, so people, if they're Googling what you're saying, they're probably just going to be like, well, that's not, I don't. So this is more of a strategy that a lot of business owners use, like Ramon had said. So what people do is they have their children work for them because their children are separate tax filing entities, right? They have their own social security numbers, therefore they have their own tax returns. Now, if you have a person who's, you know, 16 and works in the summer, you know, makes a couple $1,000s, you know, it might not even be worth filing a tax return, especially if they don't have any withholding, then, you know, it's probably not worth it. But if you have, you know, your own kids and you want to put them on payroll, you could pay, 12,000. I think the deduction is 12,400. Okay. I'm not mistaken. But so essentially what that is, the 12,400 is the standard deduction for your personal tax return, right? So each individual person, you know, as long as you have a social security number, you're entitled to this $12,400 deduction. You could be a business owner, an employee, or someone who's unemployed. You're going to get this deduction. Now, it's not going to generate like a refund for you per se, but it's going to wipe out $12,400 worth of your income. And this number changes every year. It can go up, could go down, but you just have to know that. So what Ramon is talking about is parents pay their kids up to that amount because, like I said, it's going to wipe out your income. So you're going to make $12,400, but on the tax return, it's going to report that you made zero because you're going to wipe out all of that income and thus not have any taxes. So a lot of my clients, for example, they have kids who are in college, you know, and they're just like, oh, I, you know, send him money for, you know, books and college expenses and stuff like that. It's just like, well, just, you know, put him on payroll. He's here in town. Just have him come work for you, you know, on the weekends or something like that. And it doesn't have to be anything super crazy, you know, like they don't have to be out there consulting with you. You know, they can do administrative stuff like filing and cleaning and shredding and things like that, which is why I don't remember the ages off the top of my head. But yeah, for smaller, younger people who are like 13, you don't want to trust them to answer phones. But you know, you can have them do those menial things and put them on payroll and pay them, you know, if you're going to have to pay for stuff for them anyways, like, you know, extracurricular activities and allowances and stuff like that, why not add them to your business payroll teach them a little responsibility, while at the same time being able to write off that $12,000, from the business side, as well as the payroll taxes that are in addition to that. So it's kind of like it checks every box of everything that you want. So why not do it?
Man, that's big, because I know a lot of people who have businesses, but their kids don't work for them.
Mm-hmm.
Some that do work for them, but like you said, with a lot of people that are starting a business, if your kid is of an age where there's something that they can do, like you said, mm-hmm. meaningful, but it can be something that you like, all right, I don't want to do that.
Mm-hmm. Yeah.
Put these papers together. That's simple.
Mm-hmm.
Pay you for, I think that's big, man, because it teaches, you paying your kid, but you're also teaching them a lot,
Yep.
When they get out to this real world, you don't really want them working for nobody else.
Right. It also teaches them to be competitive, because a lot of kids have to compete with the Byron Trumps of the world. He's a teenager. He's going to grow up and, he's going to have a lot of things, handed to him like his siblings did. So this teaches your kids, while you're earning some sort of, credit for your business, to be responsible and to how to acquire wealth. I mean, what's better than that?
Yeah. And especially for example, I mean, you're not able to contribute to a 401k until you're like 18 or 19, I want to say. But say you have a kid in college who, you pay them to come work for you. You could also set up a retirement account for them, like a 401k with a company match. And so, you could, maybe pay your kid, $12,000 is the deduction. The deduction for 401k contributions is like 19. Obviously, you have to really love your kid to do this, but you would pay them essentially a salary of like $25,000. Max out their 401ks, which is for their retirement. They can't touch it till they're 60 something anyways. So you set them up in terms of before they've even left college, they already have a maxed out 401k for the future, as well as money in their pocket that's not taxable. So you just have, all of these extra, and that's just like the beginning, for example, like, and this is for what a lot of businesses out there, like S Corp, for instance, when you have medical expenses, those aren't fully deductible, in the sense of, if I pay $100 in medical expenses, likely $0 of that is going to be deductible. You have to spend a certain amount, and then you can start deducting anything above that amount. So what a lot of people, do is they gather up their medical expenses and give them to their accountant, but it's, it doesn't result in anything. So if you have a business, you can set up a health reimbursement account, which, the business reimburses you for your personal medical expenses, and the business takes that deduction in full because they paid it to you, and it's not taxable. So there's little nuances like that where you just tweak a little something, just change one aspect of the situation, and boom, it becomes fully deductible. So things like that, for if you have your employee or your kid as an employee, you can set up a health reimbursement account for, if they have to have a surgery done for an athletic incident, or, just stuff like that, where ordinary parent stuff can now become deductible if it's set up in the proper way. If it's done, all the boxes are checked and everything is done up to code.
Wow, that's amazing.
A lot of information, man. I hope people really take heed to that. Man.
I know. I mean, when we think about wealth, you think about what you're gonna just give to your children. Here, I'm dead and gone, and this is what I want you to have. The blood, sweat, and tears of my legacy. But I mean, to have it explained like that, it just puts everything into perspective. How wealth was, kept from Black people, because we didn't know any of this. Like, we have, people like yourself now, and, and others to provide us with this information, because you're so educated in, that field. That, I don't understand how people can go, owing, hundreds of thousands of dollars to the IRS, or, not being able to take advantage of so many tax advantages. They're out there, they're here, but I think what happens is a lot of people get scared or embarrassed, and they don't want to speak to a professional like yourself because they automatically think, oh, he's going to judge me, or he's going to think, he's going to think I'm like this or like that. But you can't be scared. You got to go out there and get it done. I know I was embarrassed, to hand some of our tax information over to, to my baby brother, but it has to be done. You got to be responsible. We're adults. We got to do it.
Yeah, definitely. It's I mean, to that point, it's like you guys, right? It's like you guys. I mean, Ramon, I don't know. I mean, I've met your dad, love your dad, but I don't know if he was all into real estate and stuff like that. So it's like for you guys are going into this, not experiencing firsthand, what it's like to have a parent who's investing in real estate, flipping properties and stuff like that. You guys are kind of learning from others and then applying it to your own personal situations. And that's, kind of what we have to do as Black people in this country of, you're self-made. And then with the hopes that one day you can pass that off to, family or, your children, that the lessons that you have learned while keeping them hungry to become that self-made individual, but you also want to give them a better life than what you've lived.
Absolutely.
Definitely. I think with that too, one tool that has been used to transfer wealth in this country that a lot of us didn't know about, and we always wonder why we see kids that's coming up and it just looks like they were just born with money. Is the 1031 exchange, and we've talked about that before. We've done it before, and when you really understand how powerful that is, can you kind of just give us a little snippet on that and how that works, and what's kind of the tax advantages of using a 1031?
Yeah. So the advantages of a 1031 in the most basic sense of the word is you push off a gain on a property, right? So if I were to sell a piece of property, then I would be taxed on that gain. But if you 1031 exchange it, then that just pushes it down the road. And so what a 1031 exchange is I take a piece of property, and really now it's only real estate. Before, it used to be like when you would go and trade in your vehicle, that was technically a 1031 exchange from the business side, but they decided to lessen the paperwork. So now when you trade in your vehicle, it's actually like a sale, and you report that gain on the sale. So now really only 1031 exchange is in reference to real property. So your land, your buildings, all that stuff. So let's say you have a piece of property that you want to trade for another piece of property. In essence, you're just trading it. So what you would do is you find a broker who specializes in 1031 exchanges. And I will say that is very important, because I've never seen a successful 1031 exchange that didn't have an intermediary. You can't just do this yourself. You need a third party who knows what they're doing in order to do this successfully, because one wrong move, that gain becomes taxable.
And what's that gain called? Or
capital gain.
The when you say when you make that one wrong move, do you know what that is called when you have to pay the capital gains tax on that?
No.
Oh, yes, you did. Why?
Hey, I was asking either one of y'all.
Oh.
so we could educate these people. It's called a boot. I'm sure you probably know. Maybe yeah. So you don't want that.
Yep. So what Ramon is talking about is boot, which is kind of like a value added into the deal, such as like cash and stuff like that. But if you do it improperly, then the whole transaction itself can be classified as like essentially boot if you're using like 1031 exchange logic in the situation. But yeah, so you always need an intermediary who knows, who's done a 1031 exchange, because effectively the money can't touch your hands because the moment it touches your hands, it becomes taxable. So that's why you need an intermediary. So a lot of people, for instance, if I have a piece of land in Nebraska, right, and I wanna trade it for a rental property in Kansas, I can 1031 exchange that land, which is essentially you sell it and then you immediately reinvest those funds into buying this other property. Is logistically how it all works out. But so like I said, that's another little nuance of you could sell that land and then go buy that property in Kansas, but then that becomes taxable. But if you add that intermediary who knows what they're doing and 1031 exchange it, you buy that property or you sell this property, buy it, and now it's not taxable. So there's those little things, and so that's very helpful for when you have one highly appreciated property, like for example, land in Nebraska is like skyrocketing. It's a seller's market. People, in western Nebraska, northern Nebraska, that was all previously like farmland and uncultivated land, now is becoming suburbia and expanding. So, that land in essence is going to be way more valuable now than it was before. We had a client, it wasn't my client, but I heard a story where someone owned land that can't remember if it was Google or Facebook wanted to build a data center on here in Nebraska. And so they, the Google or Facebook was like, we want to buy it for, this much, way above market value. And the people were just like, well, I mean, we want to, but the taxes on that are going to be like terrible because of the fact that it's just going to, they're paying so much more than it was bought for, 60 years ago. Like we've had this in our family for 60 years and it was bought for pennies on the dollar. Now you're selling me bars of gold for it. So then, you bring the accountant into it and then they're like, okay, you need to, 1031 exchange it for a, piece of property or something. That way you can save some tax dollars, convert that piece of land into something actually useful for you, that you can build a future on. And they're very happy about that, of not having to pay that gain or the tax on that gain. So yeah, that's just one of the many instances where a 1031 exchange is so much more valuable than just selling your property outright.
Yeah, then once you to add to that, I know, because basically some people get it misconstrued. They say, oh, well, you do tax free, you don't owe no taxes.
Right.
You are essentially doing or deferring the taxes. So basically giving the IRS or IOU. You're like, I ain't gonna pay you right now. I'm gonna pay you later.
But I'll pay you, later on.
And so you keep doing it. And that's what I think a lot of these families have done over the generations, is they bought these properties, held them, and then when they die, so instead of all that the tax that they deferred become due, when they pass it on to their heirs, they essentially gets wiped zero.
Yep.
Now their kids inherit all that property and none of that debt.
Ooh, that's amazing.
Don't
you wish we grew up like that?
So it's so big that people don't really understand that there's more to it than just buying property. You also, you buying for the next generation, and you don't want them to come in this world with all that debt. You setting them up. So I think you explained that great, and I love this interview. Man, we had so much information.
I know.
Like it was a lot of information. I love that.
Can you believe that this is like the first interview where I didn't spend a lot of time talking? Because I'm learning. I'm like, this I'm receiving this information. It's important that that we know that, because I ain't know none of this. I just knew you had to pay taxes every year, and sometimes I'd claim zero or exempt, or whatever.
Hey, you about to lose a sister.
Yeah. Yeah, I'm really glad you actually brought up that. That bringing up after you die. That's called a step up in basis. And, we talked about business basis or whatever, but so and this happens all the time, where a piece of property is in the family you know, and you know, the family really doesn't have a use for it after, you know, so-and-so dies. They sell it, you know, if the parent who died, you know, bought it for $30,000, you know, back in the 30s or the 50s or something like that. And now it's worth, you know, $300,000 just because of the market or whatever, the area of town that it's in and stuff like that. You know, ordinarily, if that person tries to sell it before they die, they are going to pay a huge tax on it. So what happens is that people hold on to it, put it in their will, and then when they die, it transfers to their kids. And now that the kids no longer have a $30,000 basis of what it was paid for, they got a $300,000 basis. It just instantly jumps from one to the other, which is called, you know, a step up to fair market value. So at the date of death, whatever the fair market value of it is now the kid's basis. So they could sell that house for $300,000 and pay zero tax on it, you know, and that's obviously very powerful when you have a lot of property or, you know, that Google data center. You know, someone wants to come and buy that land that your grandpa, you know, bought way back when. So, you know, it's just like that preservation of wealth for the future. You know, people like for the instant gratification of, you know, I want it now, I want it. When sometimes you just have to take a look into the future of, you know, obviously it's not going to benefit you for that step up in basis of when you die. But, you know, if you want your kids to, you know, get a huge influx of cash after you die, in addition to your life insurance or whatever else money that they're going to get, you're setting them up in a great position to succeed and to build a better life for themselves. So rather than just giving them money, you have a setup to further their economic goals, really.
Man, I couldn't have said it better.
Well said. Yeah, well said. And that just kind of goes into our last question. What does wealth mean to you?
That's a great question.
We're gonna get the accounting technical term. Should I get a dictionary out?
This is me taking my accounting hat off.
Oh, okay.
Wealth to me is fulfillment in life, right? So for me, I obviously want to make a living, right? And I want to have enough money to go do the things that I want. But if I have to, you know, work myself to the bone to do certain things, for example, I want to one day travel to Europe, right? You know, if I have to become a millionaire to travel to Europe, I work to become a millionaire and then I want to travel to Europe. That's not fulfilling to me. I want to do, you know, have a life, but at the same time have enough money to go and do things. So my bank account probably doesn't seem like I'm wealthy, but at the end of the day, when I have kids and things like that, I don't want to look back and feel like I haven't done certain things in life because of, you know, monetary limitations, you know? So that's what being wealthy is to me, is just having full fulfillment in my life of I've done, you know, looking back, I've done what I've wanted to do and no one's been able to stop me. And, you know, I might not have, you know, 6 zeros in the bank account, but, you know, I've had a wealth of life experiences. And to me, that's what it means to be wealthy.
Yeah, wealth is not always about monetary value or, you know, like you said, having the, you know, the money in the bank. Wealth means different things to different people. And that is the importance of, you know, getting everyone's opinion about what wealth means to them.
Mm-hmm.
And that's so fulfilling and it's so sweet, just like my little brother. We're gonna pick those.
Hey man, we appreciate the interview, man. This was definitely.
We really do.
I was waiting on it because, you know, it was monumental. I hope everybody that's watching this, that's gonna see this, that they take a lot from it, because there's a lot of information here for not just Black people. I mean everybody.
Everybody.
Yeah. But man, you know, I applaud you for even being an accountant. You know, it takes patience. You know, that a lot of us don't have. So, before we go, please tell everybody, you know, how they can reach you, and we'll put all that in the notes when we post this. We head out.
Yeah. So best way to reach me, you know, I don't really do the whole social media thing anymore. You know, Facebook.
Not yet. You don't get on.
Yeah. Yeah. You know, when I become a social media sensation, then maybe I'll hop back on it. You know. But yeah, so the best way to reach me is by far email, especially this time of year with work being so hectic. And my email is just my first and last name, Devon Billups @gmail.com. Pretty simple. Yeah, and I'm more than happy, you know, I'm not really doing my own thing right now. Just with the fact of it's always great to have a support system. You know, venturing out into your own can be scary, which I don't know if I want to do one day, maybe not. Right now, I'm just absorbing everything like a sponge, you know, because I'm working with people who have, you know, close to 100 years of tax experience, you know, so I'm just, you know, looking at each situation that a client has and just absorbing what they're doing and learning from them. And then once you venture out into your own, you might not have that. So yeah, best way to reach me is by email. And, you know, if you are interested in becoming a client or interested in some extra off season work or consulting or things like that, you know, you can always reach me and we'll talk about it. I'm always open to, you know, like Kendra loves talking. It runs in the blood. I enjoy just talking to people. It's what I do.
Yes, I'm so proud of you, little brother. And thank you so much, our audience, for tuning in to the Slow Wealth podcast and our streams. I am Kendra, and this is Ramon. And again, we have Devon. You can reach him at devonbillups@gmail.com. We are on all podcast platforms, and we're on Facebook. You can email us at invest@slowwealth.com. That's invest, INVEST, at slowwealth, SLOWEALTH.com.
Facebook and YouTube.
Oh, yes, and YouTube, because we have a YouTube channel. We just, you know, gotta perfect some things. Gotta get more savvy.
By the time you guys see this, we're gonna be on YouTube. So, hey, man, appreciate the interview, and we hope everybody have a blessed day. And
love you.
Love you guys.
I love my little brother. I miss you so much.
Yeah, I'll have to get down to Texas.
All right, love y'all. Devon, don't hang up. Love you, Ramon.
All right.